The broadcast is now starting. All attendees are in listen-only mode.
Hey, good afternoon, everybody. This is Dan with Nadex. Happy Friday. Glad you could join us again today. Looks like we have a few new people in here, as well as quite a few that have been with us all week. Hopefully, these have proved a bit beneficial and given you a little bit of at least a platform to start from when getting into the platform and looking at the contracts. And that's the whole point. Um, really happy you can join us. As I mentioned at least a couple times this week, I've seen over my history that the people that really have the best shot of being successful at trading, not just for a week or 2 weeks, but really for the long term, is that they never stop learning. They participate, and I just really love this week all of the feedback. I've been talking all around, well, not all around the office since we're all work from home, but with everybody that I used to see at the office via our Skype meetings and things. Just how excited I am about this and what great audiences they've been. And apologies for a second, I'm just getting attacked by a golden retriever here. All righty. So today we're going to be talking about actually what I think is the best contract at Nadex, and one that has not really received enough attention over the years. And that's our call spread contract, particularly if you've been, I think, trading futures, trading Forex, even for newer traders, I think they take a little bit longer, a little bit more work to be really to be proficient at them and to really understand them. But once you get it down, and like all things, you put in the required work and you get it down, it pays rewards. But they just offer a lot of benefits. So today we're going to be talking about the call spread contract. We're going to be going over the basic elements, like the previous few days. We're going to be executing some trades and looking at capital requirements and how to close those out, obviously, and manage those trades. All right, so quick risk disclosure. Trading involves risk. If it's at Nadex or anywhere else, put real money into a market, you can lose that money. All Nadex contracts are defined risk, meaning you know up front before you place that trade what your maximum exposure is. So you can never get a margin call fully collateralized. If you don't have the money in there, you can't execute the trade. So you have a lot of good safeguards there. We are going to be in the demo platform today. I'm going to be placing trades. That's for educational purposes. It's not something if you have a live account that you should go, oh, hey, Dan placed this trade, so I thought I'd trade along with him. As you've seen, or at least most of you have seen, I do very brief analysis. It's all about understanding the contracts. What's my exposure? What's my risk? Then what's my upside, right? It's always risk first, right? Nadex is all about self-directed trading. So understand that the trading decisions you make, the power is in your hands, and along with that power comes accountability. Nothing that I trade today is at all a recommendation. As I mentioned, don't trade it in your live account. Always like to stress that, because I have had people that have joined along before and they're like, well, I got into that trade in my live. Well, I'm sorry, but these are really for educational purposes, and I mean that sincerely. So with that, let's get started. And the call spreads actually look very similar to the knockout that we took a look at yesterday. In that trading occurs within a defined range. So you have a floor and you have a ceiling. That floor and ceiling, just like the knockout, defines the maximum risk and the maximum potential reward on every trade. The biggest difference here, the floor and the ceiling do not knock you out. They protect you, but you're not going to get knocked out of a trade. And we're going to take a look at these. As you know, I like to spend a lot more time in the platform than on boring slides with a lot of words. So we'll be in there real quick. These are great if you've never traded options before. I mean, if you have traded options before, you'll understand inherently, and you've probably traded something called a call spread. We've basically taken that simple option strategy and made it even more simple. But if you've never traded options before, I know from personal experience, and I know from talking to a lot of people, options can get very intimidating very quick. This contract does a great job of introducing you to concepts of options and what optionality is, and how that impacts the cost of premium. And really, it could be thought of as buying time to be right. And we'll get more into that concept in a bit. And as with all Nadex trades, while there's a floor and a ceiling, and you know your maximum potential upside and you know your maximum potential risk, you don't have to accept either of those values, right? You can try to close out if your trade's going against you a little bit. You can try to close out early, save some of that capital. On the other side, if it's going in your favor, you don't have to wait to reach maximum levels. You can close out at any point along the way prior to expiration. So with that, let's get right into the platform. And there we go. And at the end, I'm going to give you some places you can get some resources as well. We've got a question already actually regarding the demo trading competition, which is kicking off Sunday evening. As far as resetting demo account balances, that will happen after the close tonight, right? So Sunday kicks off, or trading kicks off Sunday evening. So after the close, so nobody can have any open positions or place any more trades. All the accounts in the competition will be reset to $10,000. So if you're still trading in your demo this afternoon, feel free to do that. Once the exchange closes, we've got some maintenance to do, and then we're going to be resetting all of those balances. All right, so let's take a look at call spreads. All right, so along the top, we first looked at binary options on Wednesday. Days fly by. We took a look at knockouts yesterday, and we have the call spreads today. Letitia, to answer your questions, you don't have to trade daily. Actually, in a lot of cases, even though this is a demo trading competition, a lot of people will. Just like real trading, right? As we talked about yesterday, cash is a position. If there's a day where you're not seeing an opportunity, don't trade. It's as simple as that. The one caveat to the little competition is that over the course of the week, you do need to place 25 trades to qualify for the grand prize. And I'll give an example because I know this question comes up a lot. Well, what constitutes a trade? If I open a position and close a position, is that one trade or is that several trades? And so here's an example. If you place a trade, let's say you place a trade for 10 contracts, it gets executed, it goes to expiration, that's one trade, right? Expiration doesn't count as a trade. But if you enter 10 contracts, close out the other side for 10 contracts, that's two trades, okay? If you enter for 10 contracts and close out 5 and 5, that's actually three trades. All right, so let's get on with the call spreads because I know we've got some limited time here and because we are coming up on the close for most of these call spreads. So for underlying markets, indices, Forex, commodities. All right, so in the call spreads, we've got two international indices, the FTSE and the DAX, which is the Germany 30. And then you should be familiar with these four US indices. On the currency side, and you can see multiple time frames here, right? In the knockouts, all of those are a week. If they get knocked out, a contract replaces them, but you can intraday trade those. Call spreads can only expire by time, and we'll cover that in depth here in just a bit, but you'll have multiple time frames. And that's important when we're talking about optionality. So on the currency side, we have contracts as short as 2 hours, daily and weekly. And commodities, we've got corn and soybeans, which are actually expiring very soon, crude oil and natural gas. So if you are into agricultural products, that is one you may want to look at. Not the most heavily traded contracts on Nadex. It's really commodities like crude, gold. Then you have your currencies like euro and pound, yen, Swiss franc. Aussie gets traded pretty heavily, as well as then the four major US indices. So let's just hop back here and let's hop into, we've got these, they're expiring in about 50 minutes. And I'll tell you, call spreads are actually, if it's this time of day on a Friday, actually a lot of the markets in general just aren't that exciting. So hopefully we can give you some good examples here. I'm going to choose this daily contract. And so let's see, where's the market for the Euro USD? It's about 182, 118.25. So I'm going to take a look here. I'm going to choose this one. And let me just zoom in on my chart here a little bit. So when you place a call spread, when you select the call spread, as you can see, I just zoomed my chart quite a bit. This is your range. This is the range that call spread can trade in, right? So we have a floor of 118.10. I'm just going to move this that up there, and I'm going to duplicate it just so you can see those a little bit better. And we have a ceiling all the way up here at 120.60. So we have a $250 contract. If you've traded currency before, this will look very familiar to the equivalent of a mini contract. All right. If I place this trade right now, right, one of the great benefits to this contract is you get what I call high effective leverage. Now, leverage can be great when the markets are running for you, but when they're running against you or there's a big market move, maybe something out of nowhere, leverage can be devastating, right? That's why you always see those risk disclosures. You can lose more money than you have in your account. That's when you're trading a margin contract. All Nadex contracts are defined risk, okay? And we'll walk in what that means. But so you can't get a margin call. You can't lose more than you put up for a trade. Trust me, I was working for a firm in 2007 when the carry trade unraveled, and I think we margined out. And by margined out, I don't just mean that they lost money on the trade. I'll give you an example. A lot of people that had 5, 6, 7,000 at the start of the day overnight probably lost 15, 20,000. That was in 2007. High leverage at the time in the currency markets, particularly. And that's when you get a call from your broker saying, hey, you need to deposit more money. Yeah, 15,000 people, I believe, that day. Disastrous for everybody involved, but particularly for those people. Can never happen at Nadex. But always, if you're trading futures or Forex, always understand that. So same thing with the knockouts as yesterday. If you're long, if you're buying, the floor is your maximum risk. The ceiling is your maximum return, all right? So if I place this trade, which would be equivalent in a tick value, I'll say, since the tick size is $1, would be equivalent to 10,000 euros, or right now would be worth $11,000. So right now to place this trade, if you look over at the order ticket, I have a maximum loss of $17 on this trade. Maximum potential return of 233. I'm putting up $17 to basically control the point value of a contract that's worth $11,000. In the FX market, you'd have to put up about, I think, 220, right around there in order to do that. So that's what I mean. You get high effective leverage. So I'm going to place this trade and then walk through a couple of items here. You know what? I'm going to place a 5 lot here because then we'll walk through. Let me real quick. Let me kill this resting order. Okay. So I'm going to zoom this in a little bit so that we can see. Anybody remember that trend line from a few days ago? All right. So now if we look at this, I'm going to bring up another drawing tool here. So right now, we got into this trade at 118.30. Our maximum risk is between this yellow line and this red line. Our maximum potential return is from this yellow line all the way up to the ceiling. Now, clearly, unless there is something major, that's not going to happen at 1:15 Central on a Friday. But we could still make some money, right? Because we can close this out. Let's say the market, and I'll use my yellow line as an example here. So just follow the yellow line. Let's say the market goes up here. This contract is considered variable payout, okay? And so if the market closes at this yellow line, we make the difference between where we bought and this yellow line where the contract expires. If, on the other hand, let's say the market comes down here, well, then we lost a little bit. We know that our maximum loss is $17 per contract. So what happens if the market comes down here? All right, these are options contracts. The beauty of an option, if you think about, even if you're not familiar with options, there's what's buying a long call. You put up an option premium, and that premium gives you the protection. So let's say this was 8 a.m. and I'm going to draw a line here. I'm just going to draw a point-to-point line. Let's say the market does something like this. All right. If the market just stays at that yellow line until expiration, well, you lost your $17. But I don't know if anybody else has ever had this happen if you've traded futures or Forex. Let's say that yellow line is our stop. I'm just going to move that a little bit. Let's say the yellow line is our stop. Have you ever gotten into a trade and the market does something like this, right? And you get stopped out. No big deal, happens to everybody. But then a couple seconds later, all of a sudden the market does this. That ever happened to anybody? Right? You get stopped out. You're like, oh, dang. And then all of a sudden the market rallies in what would have been your favor, or if you were short, all of a sudden it just drops, right? To me, this is one of the most beautiful things of this contract, is that you have all the risk protection you need, but you never get stopped out, right? So even if the market goes against you, right, you can only lose down to the floor if you're long. If you're short, right, the ceiling is your protection. And so you get the protection of what we call optionality. And I'll be answering some questions in just a minute. And this is one contract I definitely recommend everybody spend some time, because there are some nuances. Now, right now, we don't have that much time left in the contract. But I'm going to just zoom in here real quick so we can get a little bit closer view on this trade. So options. Options are basically insurance, right? You're insuring. So just like this trade, we're basically putting up a bit of premium on top of the actual trade price for the protection that if the market takes a really nasty turn against us, we're protected. No different than car insurance or insurance you have on your home. This premium, when markets are really volatile, I'll tell you, it would be almost impossible to trade a call spread last March when the markets were going crazy. There was so much premium. And think about it this way, right? When you have car insurance, if you've been driving for 20 years, have never had a ticket, have never been in an accident, you have a pretty good premium, right? Your rates are pretty low compared to, say, somebody who's been driving for 5 years, has 5 speeding tickets, has been in 4 accidents, right? They're considered a reckless driver. Their premiums will be substantially higher than yours. Does that make sense on the auto insurance part? Right? I think we're probably all used to that. I know my parents hated it when I was on their well, that was 30 years ago, but when I was on their auto insurance. Premium in the options market works the same way, only everybody is judged the same, right? There's not a good driver, a bad driver. Nobody's getting really different premium. The difference is when the markets are really volatile and you're looking at pricing options, basically with the markets like that, the people pricing the options are basically saying everybody's a bad driver right now. We need to collect more premium because we have to cover ourselves, because when you trade an option, if you're an option buyer, you have defined risk. If you're an option seller in the traditional sense, you have unlimited risk. So you collect a premium because you have to pay for some protection. When the markets are a lot slower, right, that's more akin to, well, people aren't going to get hurt so bad. They're all good drivers right now. There'll be lower options premium. And so when we think about that, like if the market's right here where the yellow line is now, if there's a high level of volatility in the market and a lot of time remaining, I may actually have to buy a call spread up here. Even though the market's right here, this area right here, and let me just see, just draw an oval here if I can. This area right here would be considered the premium. Now you'll always see more premium closest to the floor and closest to the ceiling, right? Because you're buying more protection. You have a lot more upside. And the more volatile the markets are, the more premium you'll have to pay. Let me zoom back out here. I'm going to go back to my positions window. All right, so we looked at if the market goes down, right? Now, just because you're protected by the floor here, if the market starts going down like this, you know, because maybe if you bought up here, this you might be willing to absorb that risk. You don't have to take that. You can close out early. If the markets, and let me just draw another one. Let's say the market goes up like this, right? You don't have to wait till up here at the ceiling. If I'm trading these 5 accounts, and so what I'm going to do right now, I'm going to go in and place some limit orders. We've covered this, I know, a lot this week. But again, if you want to close out a position, or if you want to place limit orders on this, simply click on your open position, right? It'll open a ticket in the opposite direction. If I was looking to close this order, I want to use a market order, right? And it's automatically the same position size, so this will close everything if I click place order. But if I'm going to set a take profit target, I'm going to use a limit order. And I'm just going to say in this example, I'm going to take 3 contracts if the market goes up to 1900, right? Not going to get greedy. I'm going to click place order, right? What that means is if the market comes up here and hits basically this level, right? That's where I'm trying to collect my first profit. Now, the analysis that you would do in any other market is the same. So if you've been trading for a while and you are using different technical indicators, whatever you're using, that's not going to change. That's all the same. You just need to understand the nuances of the contract, that in times of volatility, you may pay a little bit of premium over the market or under the market if you're selling versus slower times or when there's more time left. I'm going to go to my orders. So I have these working orders here, right? 3 working orders, got my position. Got a few questions here, so before they stack up too much. Yes, going back to the trades. Yeah, so anytime you're executing an order, so even let's say you open an order for 10 lot, then you place another order for a 10 lot, even though it's on the same market, that actually counts as 2 different orders. Yep. Yes, Adam. As far as we will be getting more weekly options in the index. We actually wanted to have those added a little bit ago, but there were a couple of reasons. We are looking to add those soon. We had to do a little bit more studies, so we'll have more weeklies in both the indices and commodities. Bill, as far as capital, the minimum initial deposit into the Nadex account is $250, which that's pretty low compared to really any other account you can open up. I mean, there's some futures brokers that allow you to do it with $500, but a little bit more difficult, in my opinion, even if you're trading the micros. If you're trying to hold something overnight with $500 and you're trading a couple of contracts, you just can't do it. So that's an important thing about Nadex. So once you're in a trade, your margin or / collateral never changes. So you can have a pretty low starting amount. For example, when I placed this trade, 1 contract, my risk was $17. So even if I don't have a ton of capital to start with, I can still keep my risk down to a very low level where I can still effectively trade. Yeah, actually, there is a referral program. There's actually a refer a friend program that's going on. I'll tell you what, if you and I should know all the details. Apologies. I know if you contact customer service from our website or even the platform via live chat, they can get you a link. So I think it's actually pretty generous. Actually, you can get. I want to say it's like $200 per referral, both you and then whoever you refer. If you open and trade, each of you get $200, and you can do that up to 5 times. So it's actually a pretty nice referral. The thing is, uh, we do our best to provide a really good service and to keep our members happy. We often say around here that we can be happy, just never satisfied. But we also understand how important word of mouth is. And so if somebody's willing to go out there and kind of, promote for us and we don't have to market, that's worth something to us. So if you hit the chat functionality and talk with our customer service, they're fantastic. They'll help you out with the Refer a Friend program. Yeah, let's see. All right. Sorry, just got a little bit of a longer question here. It's a great question, though, so I want to make sure I get every aspect of it here. Oh, yeah. So this is a great question from Adam. So, you know what? I'm going to actually click on a contract that's not, here's one. So this is what I'd call an out of the money contract. Now, you'll notice if you look at the order ticket, there's only a sell price here. So I'm going to use my yellow line again to walk through a few examples, right? So one thing, I could actually sell this contract right here. I could sell, but the market is up here. So before I can make any money at all, the market, well, I can get in very cheap. I could get into this contract for $3 and let me get rid of some lines here. I could get into this contract where you see the gray area on the screen. I could get into this contract for $3. Seems like a pretty good deal, right? But what you have to remember is this is already what's called out of the money or out of the range. So the market, in order for me to make any money, actually has to come down and hit here to 118.07. So 3 points or 3 pips below the ceiling before I can start making money. So it effectively, if the market's at 118.32, it has to move down 35 points. But let's say price was right at this red line. Let's talk about premium for a little bit because Adam's question was explaining how buy or sell, that impacts the premium. So there are two main factors in your premium when you're looking at options. The two main factors that we're going to be worried about today are time and volatility. So the more time you have, the more premium it'll pay. So consider if you were looking to insure your car for a year versus a rental car. Well, I don't want to use rental car because they would jack up the insurance anyway. But let's say you were looking to insure a car for a year versus you were looking to insure a car for 1 week, right? Your premium on that year would cost more than the week. Same thing with options. With volatility, the more premium you pay. So I'm going to use my sliding yellow line here. So let's say the price was right at this red line. See that red line? If I have, I'm just going to walk through time first. So let's say that I have a day remaining, right? I might pay this much in premium, right? But if I have 2 hours remaining, the difference between the red and yellow line is going to be my premium, right? So my premium is going to be less the less time there is remaining. If I have low volatility and low time, I might pay a little bit less, right? Because volatility will be a factor. If I have a little bit of time but high volatility, I might be paying more. So this would be the premium. If I have a lot of time and high volatility, then I might be paying like this. Now, this is when you're near a floor or a ceiling, right? When you're trading near a floor or a ceiling. What happens as price starts to get in this level, and let's see if I can find an example of that. Oh yeah, right here, right? So the market is at 118, basically 33 in this particular trade. So we're not paying any premium at all. It's right at the market. So as you go, and let me just get back to this one that we were just looking at. So as you get off what we call the wings being the floor and the ceiling, it'll start to move like a knockout in linearity, right? Because it's in the center of the range. And as it moves down here, right? Now you'll start to see it slow if the market really starts dropping until eventually it gets to here, right? Because there's always going to be a bit of a buffer between where you can buy at the floor or where you can sell at the ceiling. And it's not so much of a bid offer spread, but you'd see more of a divergence between the market and what you'd be able to buy or sell for. So anytime you click on it, so the question is about doing an order ticket on the screen without canceling the order. So if I have an open position, I can just click on that and I'll have an open order ticket. I don't have to cancel that order. If I go to my orders, this is my working order. I click on that, and now I can actually amend it. So if I wanted to make it higher, I could amend it. And then my order is amended. Or let's say I put this on and this is my working order. Oh, wait, I don't want to do anything with that. I'm going to go back to my positions. Now I can change this. And anytime I open up a new ticket, it's not going to cancel my other order. Let me go back to this example. The biggest thing, and where's our, oh, we're up $5 right now. Oh, 1936. One thing you'll notice, there are really wide ranges as well. And I want to show everyone where they can get some resources as well, because there's some really good stuff on the call spreads and how you can utilize them. And there's some really cool tools out there as well, which I'm going to be looking to hopefully get integrated on the platform here at some point, because I think there are some great options tools that would be very helpful for people looking to trade these spread contracts. All right, I believe we were on this one. So again, just to reiterate, if I'm a buyer here, right, we can see my order. This order is this little blue line, right? We're up $5. Market's pretty slow right now. In the middle of the range here, I see that I have my +5 and I have a working order for 3. Again, I think the beauty, and one of the things is these actually, somebody asked about hedging the other day. And I always classify it as a speculative hedge, only because typically a hedge, you're looking to define your cost. You're not looking to make money. So a speculative hedge, right? You want to define your risk. If somebody were short in the underlying market and they were long this call spread, right? You could actually net off. So let's say you're short here, your risk would actually be defined by this, and you can move a stop order. I'm going to show you where you can find a full webinar on that. I'm not going to go too much into that because it does take some time to really go through. But the biggest thing is keeping it simple. Buy if you think the market's going up. If you're going to be a buyer, it's typically beneficial, even though you pay a bit of premium, to buy close to the floor. Right? It's going to give you your best risk reward. Because if you're a buyer, the floor is your protection. If you're looking to sell because you think the market's going down, in that case, you'll want to sell closer to a ceiling, right? You pay a bit more premium, but it gives you that added protection. And again, you never get stopped out, right? So even if it drops down, if you're 10 points off the floor and it drops 50 points, that trade isn't closed out, right? You still have an opportunity, so you're buying time to be right. I was just seeing if we could find any market here that's moving at all, but not really looking like it. So I'm just going to click on one here. That'll be in the middle of range. 381. Just seeing if I see anything. On a Friday afternoon, it's always kind of tough to find anything that's not kind of out there already. So let's just see. We got 137. Here's one where if we were looking to trade the Russell, right here, we're not going to really be paying any premium, right? Because we might pay a tick close to the floor, but it's kind of the center of the range. We've got some upside. Again, we can trade this. Uh, it's in, we can trade the middle of the range. We just have to understand if it starts going against us, we'll probably want to close that trade out, not let it go to the floor. But in that case, you might as well trade, in my opinion, a knockout, which is always going to move in linearity. Again, I think the best thing about the call spreads is you can get a high effectiveness of leverage, but you really have tight risk controls. And even though, I've been talking about a little bit in the past few days of my experience as a trading coach and watching people come into the market and they hear manage your risk, manage your risk, manage your risk. And then they smother the market and they just keep getting stopped out, right? And it gets frustrating. And so they keep moving the stop farther away and then they get stopped out. And then they just pull their stop altogether, right? Because they're tired of getting stopped out. And that's just disaster at that point. With the call spread, you can literally smother the market, meaning you can take on really low risk and you pay a bit of premium, but you never get stopped out of the trade. You never get knocked out. It's there. You're buying time to be right. And real quick while we're here, because I know we've got a lot of the demo competition competitors in here today. Don't forget, Exchange opens Sunday night, 6 p.m. Eastern. So start trading as soon as you'd like. If you don't see any opportunity, though, don't trade, right? Treat the competition like you would an actual live account. I know we all want to win it, but it's really as much about learning. Because while it'd be nice to win the $5,000 grand prize, admittedly, the experience you get when you're actually trading and learning trading should be worth over the course of your trading life a heck of a lot more than $5,000, right? We don't want to fall into bad habits just because there's a trading competition. We want to trade it seriously. We want to utilize good risk management skills. I know some people will be swinging for the fences. I also know that if they get rewarded for that, as I've seen previously, I've seen the market reward. I'll ask a question, see if anybody has the answer. What's the worst thing that can happen to somebody when they start trading live? Like, let's say their first 10 trades. Absolutely, Henry. Henry nailed it. Yep, Jabari, you guys are dead on it. They win big. They hit on all of their trades. I've seen it happen more times than I can count. It is the absolutely worst thing. It would be so much better. And because a lot of times people will answer, well, you lose all your money. Well, no, because if you lose all your money, then a lot of people will just walk away, and maybe that's good for them. Maybe they just don't want to take the time to learn. The problem is when you make a lot of money and you do really well on your first, say, 5 or 10 trades, and I see it all of a sudden people are tripling up on their size, and then all of a sudden they start losing, and then they lose all their money, right? Because the market will take it away. Because if you're not trading with discipline, there are the market gods that will come and find you, basically. And the problem, though, with somebody that wins like 5 or 10 right away, and they feel like they've got the magic touch, they get crushed, they go to zero, they blow out their account. They will come back in and they'll deposit again and they'll repeat the process and they'll just keep putting more money in without learning. Now, some people will then take the opportunity to learn. They do that a couple of times, but it is just really almost tragic. Quick example. This goes back ages ago. This was before I was at Nadex. I was with a sister company. It was actually about a year before I designed these call spread contracts. So it was 2008, and this guy had $10 in his account. Never traded binaries before. Had traded some spot forex, didn't do well, but he had $10 in his account. And I remember this. It was like 1 o'clock in the afternoon. He put 4 binary options trades on. He bought £2 at $3 and 2 at $2. Right? Very low probability. I saw it and I was like, oh, there goes that $10. Crazy thing happened. The market moved like 40 pips on a slow, I think it was a Tuesday afternoon. his $10 became $400. Right? He was all excited and all over binaries, and even trying to tell him caution. In 3 days, that $400 was gone because he thought it was easy. It was just like long shots and then trying different things and chasing and chasing. Yeah, it's crazy. You know what, Adam, that's a great point. Yeah, if you're expecting a market movement, so here's one thing where I think call spreads are really good is because they open up at the open, like on currencies, and it's a little bit late, but let me see if I can just find one. Okay, so I'm going to draw a couple of lines on the chart here real quick before these expire, because I want to talk about what Adam just said. So I'm going to draw this line. I'm going to duplicate it just so I can keep track of it. I'm going to change this to red. Then I'm going to go to this one. Change that to red, and I'll show you what I'm doing in a second because otherwise this won't make sense. Just going to try to get where there's no gray on my screen. Okay, so let's take a look at this. So one thing you'll notice about the call spreads are there is an overlapping structure. So for example, in our daily call spread here for this Russell 2000, or excuse me, in our 8 a.m., we have one that has a floor of 1700 and a ceiling of 1720. Up here, we have a floor of 1720, which is equal to the ceiling here. So one thing that I've seen people do with call spreads, let's say the market, it's not, but let's say the market is right here at the yellow line, right? The question is, if you're expecting the market to move, then you trade call spreads. If you're not, then you trade knockouts. And I would agree with that a ton, right? But when you have time and you get average, average market movements, and I always like looking at average true range on a market, you can compare that. But yeah, Adam, to answer your question, that does make sense. If you're expecting it to move, you trade near the floor or ceiling, right? What a lot of people I've seen do is they actually take both sides of the trade. And here's how that looks. So at the start of a daily contract, we'll have a common floor ceiling, right? So we have one bracket down here, I don't want to call it a bracket, excuse me, one range up here. So just gonna put a couple more lines on the chart here. So what they'll do, I just want to duplicate that. And I'm going to make this a blue line. I'm going to duplicate that. So what they'll do, I'm just going to put a rectangle here on the chart. Okay, so let's say the market was right here in the center of that gray box I just drew. Right, it's really hard to tell directionally which way the market's going to go. A lot of times, if we've got things coming up, we may not know. So what is a strategy I've seen? This is actually, by the way, an options term is called a butterfly. So what they'll do is, because we have these overlapping, right, or where we have a common floor ceiling. So if the market's right there, the spread contract that goes from here down, they'll sell that one at this blue line. Right after that, or right before that, this range that goes from the yellow line up, they'll buy right here. Their total risk for the trade is the difference between these two, the buy and sell. That's their total risk, right? If the market moves at all, they won't see the total loss. right? If the market comes off this yellow line, if it stays right at the yellow line, but if the market, let's say this trade was placed last night, this one that they sold here, right? They would have lost from the blue line to the yellow. But this one here, they would be, and they probably would have wanted to close this out. This is what I mean by if it hits here, right? This one, they're already at maximum return. And so you're putting up a little bit of money. Now, one thing I recommend for people who are doing this, unless you're planning on not sleeping at night, one of the great things I love about this, though, is you can sleep at night. Anybody that's traded futures or whatever, is also to use limit orders. So I'm going to walk through this again real quick. So let's say we bought at this blue line. I'm going to duplicate this real quick. Right? Let's say you put a limit order up here. So you bought here, put a limit order here, right? Because it could hit overnight. I'll duplicate this. On the other one, right? You put your limit order, and it's kind of up to you where you choose to do it, and you can do multiple limit orders. Because let's say that the market, I'm going to do a point to point. You're going to have to use your imagination here with me a little bit. Let's say that we placed this trade when it was right here in this gray box. The market, we go to bed at night, dreaming of whatever. The market comes up, it hits this limit here, right? We get filled. Maybe we had 5 contracts on and we took 3 off, right? If it does something like this, well, great. We made a lot more money on this trade because all that we lost on the other one was this, between this blue line and that. But let's say overnight, while we're asleep, the market does this, right? Something in Europe comes out big, and the market goes like this. This is the importance of limit orders, because if we're asleep, we're not going to be able to manually execute this. Goes up. Oh, hey, we got filled on our 3 contracts, took in profit. All of a sudden, the market drops like this. Well, now the remaining 2 up here, we've only got like a $20 loss on in this hypothetical. And down here, if it comes like this, we can take profit on these 3. So basically, if the market does overnight something like a whipsaw, does this, and then this, we could actually get filled on both sides of the trade. This is one actually that, gosh, I started teaching ages ago, before I was ever at Nadex. I think I told you guys my history earlier this week, but I've started in the industry over 20 years ago. But almost 13 years ago, end of 2007, I started with Nadex sister company, IG, owned by the parent company, IG Group. So I worked for IG for a few years, eventually becoming the CEO of that firm. But I worked and did a lot of education, and I'd been a trading coach. And so when I designed these contracts, I actually designed them before I worked for Nadex. But when I got to Nadex and started working with their traders, we actually had a lot of truck drivers, a lot of truck drivers that were long haul, over the road truck drivers, and they loved trading oil. And they love Nadex because if you're an owner operator, it means you own your own rig. And they were highly exposed to fluctuations in the price of crude oil. So they were in tune with that market. But they couldn't trade futures, one, because the cost of capital was a lot. And 2, if they're driving down the road, they're listening to the radio, and all of a sudden they hear, hey, there's a big shock in the Middle East. And, they were, say the shock was that oil was going to be overproduced and price was going to drop, and they were long oil, they could get a margin call. And the last thing you want is somebody hauling down the road 60,000 pounds of whatever at 65 miles an hour, flipping through their cab, looking for their phone or their iPad so they can execute a trade and get out, right? So they had a lot of risk. So when I started working with them at Nadex, and this is very similar, it's not just us, it's not just the long haul truck drivers, it's everybody that has a daytime job, right? Or even a nighttime job. And one of the things I like about Nadex, and one of the things we're going to have next week, is actually trading during the day as well as trading at night, which is something that's really tough to do in the equities market. But they loved this strategy because they could basically put it on in the morning when they were going down the road. They didn't have to worry. They had their maximum risk locked in. And they'd listen and they're like, oh, oil's up $2. Great, I probably just hit my limit order. Oh, oil dropped $3. Oh, great. I just hit my limit order. And so no matter really what happened, they were protected. And so that was a big thing. But yeah, so one of the things that was a long way to answer Adam's question, but one of the things is yeah, if you're not, um, you know, if you're expecting markets to be moving, and I would say moving, in what's called an orderly fashion, if we have what we had last March, the call spreads are going to be really tough. I'd still trade the knockouts there. But if you're expecting normal market conditions, I think it's very beneficial to trade the call spreads close to a floor or a ceiling. If there's just normal volatility in the markets, you should be able to get a relatively decent price. And you can also always work in order, right? And what I mean by work in order is, let's say there was some volatility. I don't want to buy here. I'm gonna buy. I think they want 1742. I'm willing to pay 1740. That's where I think the volatility should be. I can try to work that. No guarantee of a fill. Um, um, there's no guarantee of a fill, but if I get filled, I get filled at a more advantageous price. Yeah, actually, that's in the works. So the comment is it'd be great to have more webinars with these advanced topics, and I couldn't agree more. And we've got some queued up that we're going to be doing, and there's going to be a couple next week that actually teach specific strategies. Um, there's a couple I've done on call spreads, and actually, before we run out of time here, I want to go back here. You've seen the webinars page, I think. I'm going to see if my one that I did in July is still there in the archive. Oh, by the way, so on the archive, so the one that we did yesterday should be uploaded later today. The other one that we're doing today should be uploaded hopefully before the close tonight. If not, it'll be available early on Monday. I'm just going to pop through here once because I did one back in July with the trying to remember if I did it for Nadex or if I did it for a third party. That one might not be on our platform. Oh, by the way, a very similar one is this, the one I did on trading strangles with binary options. Very similar concept to this. And if not, one of the things I'm going to be doing more as we get into what we call the slower part of the year is doing a lot more and also bringing on a lot more third parties, working with Todd Rich, our head of education, to do these advanced webinars, because I think it's important to understand the contracts. And I've thrown a lot I know a lot of the people that have joined me for all four this week or 3 out of the 4, throwing a lot of information each time. The thing to keep in mind for these is really keep it to the basics and understand the contract. But yeah, as you do that, there's some great ways to think about some advanced ways to trade these because it's really limitless. And one of the things that I'm putting together as an ebook, which hopefully I'm actually going to take a little time off here in early December, but after that I'm going to be writing an ebook as my plan for the next trading competition, which we're expecting to have in January. We've had some just such great feedback on this particular competition. And I really want to make sure that we're providing the next time that we have everything in a row. So like to a lot of the questions I see here, I'd like to have everybody have like an ebook, like, hey, okay, the markets are really volatile. What should I be looking at as far as Nadex contracts, right? Kind of like a heat map. Because while I think they're great contracts, one of the things I'm most proud about in the exchange is that no matter what market conditions, there's going to be a contract that's right to trade. Super slow markets, binary options, there's some great strategies there. Even in fast markets, though, and around news announcements, binary options are great. So it kind of depends on what you're looking at. But when there's high consistent volatility, binary options may not be the best, like we saw back last March. But we absolutely saw knockout volume explode last March because they are awesome in big volatile markets, right? Call spreads, as you know, I'm biased to these. In normal market conditions, I think they're our best contract. Again, I'll go back to the original disclosure. This is not a solicitation or an offer to buy or sell any instrument, but just something to keep in mind. And so I think having that information would be great. Let's see. What about short-term contracts? 5, 20 minutes. So if you're a scalper, I mean, the knockouts, you can scalp because they moved. If you're scalping on a market now, like Forex or futures, you can do that with a knockout, right? Because you can get in and out in seconds, right? So those on call spreads, doing them shorter than 2 hours doesn't really make much sense. Doing them a little bit longer, like weekly, does make sense, or even doing like a monthly call spread. A monthly binary option, I'll tell you right now, is really boring. And we already have weekly knockouts, so it doesn't make any sense to do a monthly because you just consistently get knockouts. But on a spread, something like that does make sense. Yeah, absolutely. Include some strategies and yeah. Oh, okay. So yeah, Don's question is he's going to be trading his live account while he's also trading his demo account for the contest. Yeah, you can do that. I would open them just in 2 different browser windows. Don. If you could open one like and just pull the tabs separate. It's and I don't know if you trade from your phone at all. You could always trade demo from phone or live. Yeah, I'm kind of old school. I like to use my phone to check positions, um, but I would rarely execute trades from it just because I'm very visual. I have to see like a big screen. But yeah, and sorry if I didn't get to that yesterday there, Don. Um, uh, yeah, it's so yeah, you can open a couple of tabs. You may want to use I don't know if you have like Chrome on one and the new I forget what the new Internet Explorer is called. I haven't really used it much. Or if you have like Firefox or another browser. But typically, if you open up a regular tab in like Chrome, and then you open up a tab like they have an incognito tab, or you can pull and separate the tabs if you have even if you don't have 2 screens, you can separate and just click on them. One thing I would say is just make sure that if you're intending to place a demo trade, it's not so dangerous if you're intending to place a live trade, but you accidentally do it in demo. Because you miss an opportunity, but missed opportunity doesn't cost you anything. Make sure that if you're intending to place a demo trade, you're not in your live account. Uh, I think on the iPad, so we used to have an iPad app a long time ago, and we're constantly working to make the current mobile version more scalable to the iPad. I personally don't have an iPad, so it's been a while since I've looked at it. I know I've talked to several people who do. Um, I would give it a shot. We've worked a lot on scaling issues. So you can look at an iPad. Is it ideal? Is it 100% what I think it should be? Just from some feedback, I don't think so, but I would definitely look for that. Uh, you know, I would before you're trading live, I would take a look at the iPad and just see what the experience is. I know it can be done. It's based on PWA or progressive web app technology, so it certainly works on there. But every user has their own experience and expectations. So there shouldn't be a ton of limitations. But before you're trading live on it, I would trade demo on it and just see because every user is a bit different. Oh, thank you for the feedback. Yeah, we've got Jabari who says uses it just fine on his iPad. So there's some feedback. I mean, I'd still recommend try it out for yourself. But yeah, it's thank you for that feedback as well, Jabari. That's good to know. Let me hop back here. We're actually getting close to expiration. Oh boy, our trade took a turn for the worse. We're down 110 now in that 5 lot we put on. So there are, oops, sorry. So there are different volatility indicators. The question is volatility an indicator on Nadex? There are some different volatility indicators, but not the volatility indicator, if that makes sense. So, or I mean, I should say there's some momentum indicators that can give a thing, but not a straight volatility indicator. I actually still pull my volatility up off the underlying markets if you have access to that, and the reason being volatility on Nadex. So all indicators are actually based on the market, which is one reason why, basically based on the chart you're using. One of the reasons why we don't have what is that? Geez, I can tell it's getting Friday. I just got totally distracted by a golden retriever again. I'm dog sitting. So when you have like the quantity in oh, thank you, Adam. Adam says momentum indicator works pretty good for volatility. It should. It's not an exact. We've got the Chaikin volatility, which I honestly haven't used that much. I'm very simple and I'm stuck in my ways from that. But a lot of times I've seen people do analysis on the actual underlying markets. Like for instance, if I'm looking what to expect at Nadex, a lot of times I'll go out and I'll look at what the implied volatility is in the underlying options markets, which for me, because Nadex is a derivative, if I can understand what the volatility is in the underlying market or what it's implied to be, that's going to help me determine what could happen in the Nadex markets. Well, unfortunately, no single stock trading at Nadex. Those are all covered under SEC regulation. Nadex is regulated by the CFTC, Commodity Futures Trading Commission. So we do not list single stocks. Awesome. Well, with that, I'm going to let everybody go enjoy their weekend. I hope these have been useful for you. Thank you again. A lot of great questions. Sincerely, I want to wish everybody the best in the competition next week. I really appreciate you all taking part this week. Hopefully these have been helpful. I've loved, I love talking about the basics, but I love the questions. It really, like you guys literally make my day every day. And oh, hey, Francis, I'm actually pulling the final numbers right after this, but it's we're going to have a few thousand in there, so it's gonna be a good time. Jabari just nice scalped a knockout on Nasdaq. Perfect. Really appreciate it, Lisa. Again, we're going to be having some, be sure to check your emails all week next week. Each day, I'm going to be sending out a leaderboard for the top 10, whether you're in it or not, because you registered, if you register for the competition. I've got a couple of very special webinars next week. I've been reviewing them with the educators doing them. There are going to be a couple of great strategies. Really looking forward to that because I think that'll go back to Adam's earlier questions and having some more advanced strategies. Going to be some good stuff. And for the next competition, it's going to be even better. We've taken away a lot of lessons from this one, and really just looking forward to a great competition, having you all participate. And anything we can do here at Nadex, just let us know. Have a great rest of your Friday. Have a great weekend, all. Get some rest because Sunday it kicks off. Exciting times.